Hey traders, this is Ron Hadat Market Tamer. Happy Monday and happy Memorial Day. As always, nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and the specific financial issue shall always be addressed to your financial advisor. We'll kick off here looking at a daily chart of the spiders, but we're also going to be looking at weeklies, and we're going to do comparisons on the major indexes. Okay, first up, SPY. Zoom in, December low, May high, and what do we have here? Breaking through moving averages, we broke the red line, which is the 20-day EMA. We broke the 50-day in orange, and the 200 days next. So we've cracked moving averages. We've tried to get back above them. We're rejected. That is a lower high, and now we're coming down, and we gap lower on Thursday. We have not broken below the most recent low on 513, which would give us lower lows, lower highs, lower lows. That's the definition of a downtrend. That's a downtrending channel. But even though if we get maybe $2-3 lower on the spiders, which is 20 and 30 S&P points, the 200-day is still here. And that's the purple line. That is the major institutional moving average. Last time we got below it, or hit it, I should say, is back in March. So we get below there, that is big news. So alerts basically go to 275. I don't necessarily care if we trade below it as much as if we close below it. So daily chart S&P, we've lost 2 moving averages. The outlook then going for this week, it's bearish. You're below the 20 period and the 50 period. The bulls do not have the edge right now. Below the purple line, any hope they had is now toast, and it shifts bearish. So let's take a look at the diamonds, see if they're doing any better. Zoom in. Here's the peak. We came down, and the Dow was the first ETF to hit the 200-day. We bounce up, just like the spiders. We are rejected at the 20-day EMA in red and the 50-day SMA in orange. And we've already come back down, test the previous low. It's not about lower lows right now, more as much as, if we break the 200-day, that's bad news. Because, like I said before, we can use Fibonacci's and other things, but the target, because it was such a brisk rally, is all the way back in December. Like I've said before, I'm not saying that's going to happen, but that's the next major support level, just FYI. We take a look at the Qs. Let's go ahead and zoom in. They went up to new highs in April and May. We've broken the 20 and the 50. We come right back up. Now the Qs were able to get back above the 50 on the 16th and the 17th, but rejected at the 20-day. They rolled over. Technically, they've already closed at lower lows. So lower highs, slightly lower lows, downtrends in place. Selling volume's been picking up. But because the 200-day is so important from an institutional perspective, that's really the area to watch. If the 200-day would be somewhere down here, this would not be a good sign right now. But because it's there, there's some hesitation before going all out bearish or more bearish, in my opinion. We break the 200-day, then back to December would be the target. If I look at the IWM, which is the small caps and the mid caps, these are the bad omens for the indexes. They are waving yellow flags big time. If you go back and you look in October, November, and December, the IWM, small caps, MDY, mid caps, they were breaking down first. It was almost like the heads up, the canary in the coal mine, and then down we went. They're doing the same thing now. So if I zoom in, they're already below all 3 moving averages. In fact, that happened back on the 13th, 2 weeks ago, to the day. Then on Thursday, we gapped below and then finished towards the lows of the day. That close on Thursday is a new closing low. The target for the IWM are the December lows. That's 25 points lower, 20% lower almost. That's crazy, right? But that is what the chart is showing us at this stage. Now, it doesn't mean it can't stop and pause. There's Fibonacci retracements and all sorts of things. It's a news cycle. Anything can make these indexes turn up or turn down, but there's nothing to catch it. And that is the very worry. If you're a bull, the part to be worried about. You're the MDY. Midcaps. They also closed, let's see that closing price, 338. The close here was 337. So we're almost there. Close enough, right? Its next target somewhere down here. Give it one more 50 cents, $1 more. That's all it's going to take. And then we're going to break down. But even though the MDY and the IWM are already breaking down. They're below their 200-day. They've even broken previous lows. How do the weeklies stack up? So now I'm going to go to a 2-year, but instead of this being a daily chart, I'm going to go W for weeklies. On a weekly basis, they're below the 20 period and the 50 period. There's this little bit of support from this little pause back in March, but again, it doesn't take much lower and the target comes all the way back down here, or maybe the 200 period on the weekly. But that's still over 10+% away, and that's huge for an index. Here's your Russell 2000, clinging, target down here. So MDY, IWM, they look pretty much the same. However, if we go to something like, let's do SPY, they're above their 20 or their 20 period in red, holding up quite well. So weekly charts are still bullish for the S&P 500. The Dow, the DIA, pretty much on it, barely below it. I would say bulls get the edge here. And then if you look at the Qs, they're pretty much on it, barely below it. I would still give the bulls a bit of an edge here too. If we start losing the orange line on the Qs, on the diamonds, and the SPY on the weekly charts, then the weeklies go bearish too. So comparing the two, weeklies still hanging in there. Dailies, they're not. There's major yellow flags. So before I'd want to go out and initiate a bunch of bullish positions, I would be very, very picky. I'd be very cautious, maybe even want to reduce bullish exposure, or at least for initial new trades, lower the amount of contracts I might consider to place, because it's not cut and dry with the bulls winning. If I was a bear, I'd be starting to pay more attention on a daily basis, because if some of these moving averages continue to fall or lows fall, previous lows get broken, especially, in fact, let me just show you a 1-year daily. We break here, and then the bearish trades would be preferred over bullish trades. Right now, we're sort of in between. So I think caution is warranted. But if the IWM and the MDY are the canary in the coal mine, looks like we may have some trouble ahead here. By the way, they often say sell in May and go away because the market crashes. That is a complete farce as a probability percent. In fact, if I take you to financial, okay, and I come over here and I go from now even all the way into, let's say, October 4th of this year. They say sell in May and go away. The most bullish time of the year is typically November to May. They like to get headlines and clicks and try to scare everybody. But the facts are, if you read this, the SPY is projected to rise by a whopping 0.05% over the next 19 weeks, 69% of the time. That means we're basically going nowhere from historical probability. Now, there's no guarantee we can't go up or we can't go down. But considering all of the SPY's publicly traded history, the net is flat. It doesn't mean the market's going to crash. Could we? We sure could. We crashed in December, and that was, I think it was the worst December on record. So those outliers can happen, but from a probability, you don't have the wind at your back if you're a bull or a bear. So we got to be picky, and I think in my opinion, we got to be picky. And I want to be very particular in what type of stocks I may want to trade bullish or bearish. So enough said on that, just to give you some ideas on how does the summer unfold. Actually, it's a coin toss, and there's usually not a whole lot of movement once you get through the next couple months. There may be ebbs and flows in between, but not a whole lot. Okay, let's keep moving here. I want to look at XLF on a daily. We bounced off the 200-day Thursday. If the banks break the 200-day, this is the banking ETF, the target is the low for March. If we take a look at IYT, which are the transports, look what they've done. They crashed through the 200-day back on the 13th. They could not get back above. They break right back below the 200-day on Wednesday. Now you're getting a little bit of tweezer bottom-esque here, but there's support. There's a double bottom at 180. That does not, if you're a candlestick aficionado, that is not a tweezer bottom any stretch of the imagination, in my opinion. We would want those at below a support level, a spike down, some indication there could be a bottom. Near support, I just call it a farce. It's fake. I don't trust it at all. Watch 180 on the transports. If we go to SMH, the semis, they've come down hard in part because of the trade war in China. There's always a reason why they seem to push stuff up and down. Back in December, it was the same thing. Now here we go again, massive volume. We've even broke the 200-day 2 days in a row on Thursday, Friday. Target for SMH on a daily chart is, because it was so choppy, it's not that far off. I would say 95, about 5% lower, all the way down to 82.50. That is a huge range, but look how much back and forth there was, right? There is an unfilled gap right around 90. If we do weeklies, and I'm going to make this video just a teeny bit longer because I didn't do videos Wednesday and Thursday. I was away at a family event this weekend. So let's do a weekly chart. You can see how the semis, big volume coming in here, closed below the 50 period. So that on a weekly basis, 85-ish would be the target on the semis. The transports, a little bit of support right where it's at, and then back to the 200 period because that sort of acted as support. That's 165, that's 17 points lower. And then the banks, XLF holding in there, which is generally good for the broad market. If they break down, you have a little bit of 25 and then back down to the 200 period, which stopped the sell-off cold on Christmas Eve. And last but not least, let's look at Apple. This is going to be weekly. So I get asked about Apple, Google, and Amazon the most. Apple's broken through moving averages, target 200 period, right around 142. If we do Google, let's just stay on weeklies here. It closed below the 50 and the 20, target basically 1,000, which is around the previous low from the end of the year, and then the 200 period, and then Amazon holding up quite well. So it still sides with the bulls, and the last 3 weeks would just be considered pullback. If I go daily, look what happened to Amazon. Broke below moving averages, target 200 day, and then back into this chop. If I do Google, we lost moving averages on earnings. We broke the 200-day, rallied into the 20, and failed. So if 1125 fails, look at all this chop. 1,000 is the big target, but on a daily, anything in here could be support. So from Google, if we get back below 1125, I'd probably go with bear calls rather than just being directionally bearish if it were me, because I'm not so sure they're going to just keep beating Google down there. And then Apple. 170-ish, and then down to an unfilled gap back in earnings in the 150s. So hopefully that gives you a nice overview. Again, to recap, daily SPY is bearish. Weekly SPY is still hanging in there. So we have a 4-day trading week. We'll see if we get some resolution here. And I'll be back with you tomorrow night in another video. So wish you and your families all the best. And again, happy Memorial Day to everybody out there. All the best. Bye-bye.